After retiring as a major in the Indian Army, Anil Sarin entered the investment world, working at multiple marquee companies including Bessemer Venture Partners, ICICI Prudential, and Edelweiss. Today, Anil Sarin is the ED and CIO at Centrum PMS. I sat down with Anil to learn more about his investment framework, key sectors of the economy, and lessons learned from his time serving the country.
Sensei Kujaku.
Hi Anil, thanks so much for doing this.
It's my pleasure.
So Anil, I actually want to start with your own personal journey. You probably have one of the more interesting journeys in this space compared to pretty much anyone else I can think of. While most people start off either as engineers or CAs, you actually took a far more unconventional route. You joined the military and the army, serving the country. Can you talk about why you chose that path?
Yeah, my father was in the army, and I was in a boarding school, which was called a military school. So there was a lot of influence coming from the family and from your surroundings. So it was only natural that you sort of move in that direction. So I came back to Delhi and did my graduation from Delhi University, but then I sat for these entrance exams, and that's how I ended up in the army.
What was that experience like in terms of, what lessons did you learn? How did it train you to be who you are today?
So I can tell you, I mean, it was a great experience for me. I perhaps I hated some of it in the moment, but as I look back, some of the leadership skills, some of the leading from the front aspect that the military teaches you, do it. I mean, show it rather than tell it is the kind of ethos over there. So first you do it, and then you ask somebody else to do it. So these are, I think, foundational leadership skills which I imbibed while I was in the army.
Let's actually talk about leadership because it's one of those things that transcends different fields. Obviously, something like the army, it's very important. But when you look more at the investing world, how do you judge someone's leadership qualities?
No, I guess, of course, the context is quite different. But in terms of willingness to share, willingness to, help others evolve is an integral part of leadership. So, and also in terms of span of control. In my current position, I have, a modest sized team, but I do not directly approach the junior most person over there. I let the people in the middle, have their own span of control, and I work through them so that they do not lose their meaning, vis-a-vis the junior most people. If I start directly talking uh, to them. So that's one aspect. Second is that I hold them responsible if the junior most people are not evolving or improving in their trade. I tend to sort of get after the mid layer and saying, are you doing enough to sort of help them grow? Or are you holding information? Are you holding access to management? Because this is far too common in our field. So I think that's where you can sort of use the leadership skills of the military into something as different as investing.
Talking about a sort of hierarchy in the army versus, say, in a civilian field, how much of a difference do you see in terms of compliance with orders or instructions? I imagine that in the army, once an order is given, there's not much back and forth and things tend to be more decisive, for obvious reasons. But once you moved into a more civilian field, do you see that same level of compliance, and what complications do you see arise as a result of people maybe not necessarily listening to orders at first go?
So once again, I mean, the context is very, very different, and the skill set and the objective is also very different. The military obviously is about teamwork. If people don't do their assigned task, the whole objective gets not met or defeated. Investing is mostly a solo affair. So I guess teamwork is not that important over here, and obviously then the compliance part is it's of a different kind. It's of delivering what you are expected to deliver at the time when you are expected to deliver. So I think in a certain way, it is more rigorous, and at other ways, as it involves working with a large mass of people, it's not so relevant. So taking responsibility, taking ownership, doing what you say and saying what you do is something that translates very easily from there to here.
So, Anibal, let's actually now transition to your investing career. After the army, actually, let's begin with that. Why did you choose investing over, I suppose, any of the other fields that you could have moved into?
So yeah, when I was in the army, I mean, we tend to train a lot. So there are these courses that people are sent to. Typically, 2 months of training is there in some course or the other course every year for every officer. So I would go for these basic courses, and I would do well, more on the intellectual side than on the physical side. Though I was an instructor in weapons, which is the physical part, but even on the more theoretical part, I was doing quite well, and I was a trainer or an instructor at the military school in Mayo. It's called the infantry school. And so I had morning time, I would be imparting the training, and then I had long hours when I would have pretty much nothing to do, and they have a giant library. So that is where I started spending a lot of time, and I became exposed to corporates, to all these other concepts of management, all these principles. So reading about that sparked my interest, and one thing led to the other, and I moved out.
Got it. So let's talk about some of the initial things that you did once you moved into the investment world. What were the series of roles that you had in this field, and what are some of the key lessons you learned in the initial phases, or maybe not lessons you learned, or even some challenges you faced?
Yeah, so I guess it's a daily experience. I mean, each day you feel, when you look back, you say, I could have done better. I was being foolish and all. So it's an ongoing kind of an exercise. But my initial days, I was too trusting. I was too credulous, and I have lost a lot of money taking people at their word. If there is an advice I would give to my younger self, it'll be that be more skeptical, look at the incentives of the people, and please, for heaven's sake, get back and check whether people are following through on doing what they said they would do.
Anil bhai, let's now talk about your thoughts on investing specifically and how you go about evaluating businesses. There's two sectors that I really want to talk to you about today. One is real estate, which has been sort of more in the news in recent times and has done well. And the second is the healthcare space, but within the healthcare space, more the hospital side of the business. So let's actually start with real estate.
Sure.
Could you let's just talk more broadly first about how you approach that sector and what is it that you're looking for when evaluating companies?
So real estate is a relatively new sector in India. I mean, if you go back to the early 2000s, there weren't too many companies listed at all. In fact, most companies, real estate companies, got listed 2006 onwards, and the most recent one is Macrotech, which was last year. So prior to that, there aren't too many. There isn't a listed history of these kind of companies. In fact, this industry was totally unorganized. It was, you might even use the phrase Wild West. People did pretty much what they wanted to do, and it was not considered to be amenable to a listed kind of a corporate kind of a setup. It was more of an individual led or a small team led industry where connections really mattered. However, I mean, much like so many other industries, this has also got very formalized, and it's acquired giant kind of proportions where companies are operating in different parts of the country. So along the way, they've got listed, as I mentioned, 2006, 7 onwards. A lot of companies have got listed. So, so they aren't. While you will find old sugar investors, you will find old cement investors. You will never find old real estate investors. Hence, there's a discovery phase that is going on. There is nobody much older than you with a lot of experience in this sector whom you can seek advice from. So we are all figuring out methods of evolving or of understanding this sector as we are going along. However, it is also a fact that real estate globally is bigger than fixed income and all equity put together. So it's not like you can ignore this sector. It's a very, very large and it's a very emotionally very connected sector. It's one of the most sacred things for a family, a home. So it is linked to something which is very, very emotionally powerful. So now for that is not reason enough for you to start studying it or start investing in. I mean, you might like to buy the house, but you won't buy the share. Why should you buy the share? So I guess that's where it becomes very, very interesting. Like I said, there is not much of a legacy understanding. So here is something that we have sort of understood over the past decade or so. Typical returns on this industry are between 21 to 23% IRR. Now, for IRR is a concept that private equity uses much more. But if you want to translate IRR into ROC, just add depreciation to it and it will become ROC. Why you use IRR is because a typical project takes more than a year to complete, typically 3 to 4 years to complete. Hence, you can't use ROC as such. But IRR and ROC are, you can say, close cousins. So, the first part, it is lucrative. Anything which can deliver you 21% or higher return is lucrative. So that's one part. Second is that earlier on, like I said, it was a wild west. There was a proliferation. Anybody and everybody would get into the sector. Why? Because the Indian investor disliked the equity market. There was very little financialization. So a very prominent form of saving was in real estate. Hence, such was the charm, and it continues to remain an attractive or a very, very charming industry or a charming form of saving for the broad mass of Indians. And for that reason, earlier on, the funding was done by the individual themselves. I just want to clarify one thing. When I say real estate, I mean home manufacturers for sale. Real estate is a broad, encompassing kind of a term. In this particular case, it is listed companies who take money from investors and they construct a home and they give it to them. So you can say like a home manufacturer company. So with that kind of a context, earlier on, during the Wild West phase, the pre-regulation phase, they could they would just advertise and enough people would come and they will become early investors and late investors and the end user investors. So it was in that manner, it was a other people's money industry. So it has two great characteristics. One, it is a rich industry. I mean, it's a business that can deliver more than 20% return on capital employed. And second, it does that because it uses the customer's money. So you don't require too much of capital. Hence, everybody and their brothers and their cousins got into this field. In Mumbai, three chief ministers in the past, their children are in real estate. So there is a kind of a closeness and affinity between politics and because permissions are involved. However, we have moved well past that stage now, and hence it becomes an attractive industry. So I already said, very little working capital requirement, high returns on capital employed, and now what is different now is from the Wild West phase, it has become a very organized sector because RERA came in, GST came in, these two things, and then coupled with that, the demonetization also came in. What that has done is it has really separated the men from the boys. Earlier on, anybody could enter. Now, because of the past nearly a decade of pain in the real estate industry, we all know what happened. It sort of expanded itself too much, and then there has been a period where there are so many horror stories that you hear people not getting their homes and all. So there was a long winter in this sector, but now it is turning around. And post the regulation, you need to have, very few people have the trust. So the biggest form of capital in real estate is trust. Thanks to RERA, thanks to GST, thanks to the long winter, barely 10% of the builders are surviving. And in order to survive and thrive in this industry, you need to be able to generate trust. And how do you generate trust? You deliver the homes to people who paid you for it. Unfortunately, there are multiple real estate businessmen who have not, delivered on that promise. So now, if you want other people's money, you need to have a brand. So let's say I mean, I'm just taking these names, Godrej, DLF, etc. They have formidable, strong brands. And if you are ABC and Company, you do not have that brand. So ABC and Company now has to go to a bank and raise capital and keep investing for the first 3 to 4 years, and only then he will start, generating sales, because he does not have this critical thing called brand or trust. Whereas some of the other players who are well known, they just need to advertise and they will start getting the money. So this sets up a very interesting dynamic where the few people with the trust and with the brand, they will generate far higher returns. And because of that, with each round, each project of theirs, they will get bigger and more prominent, and because of being more prominent, they can even charge more per square foot. So you see the terms of trade are getting adverse in a very dramatic fashion. Hence it leads to something called pricing power. So the three things which I like about real estate industry are high returns on capital, other people's money, and extreme consolidation leading to pricing power for the few remaining survivors. And we all know that the key thing in business, the key thing in investing is to invest in companies that have pricing power. So that's why I like this industry.
So let's talk about reputation a little more in this field. A major issue, if you look at even fairly recent history, has been that buyers have been sort of enticed into buying properties that aren't even developed as yet, and then there've been a laundry list of complications that arose later.
Yeah.
So how do you gauge a developer's reputation, and what makes you confident that that reputation is not only going to sustain but lead to true economic benefits for the company and therefore its shareholders?
That's a very important aspect. In any industry, initially there is that so-called Wild West phase, and then regulation comes in, and then players start behaving responsibly, and actually those who don't, they then fall by the wayside. We've had this banking regulation in 2002, 2013. Gold finance companies were regulated around the same time frame. Microfinance companies were also regulated, and post that, there has been responsible behavior, there has been scale, and there has been wealth creation. SKS, which was later on called by a different name, or this Muthoot and Manappuram, etc. And then the whole host of banks which emerged post 2002. So I consider regulation to be a kind of a turning point, post which a lot of shareholder returns can be created. So obviously, I mean, post that, this 2016, I think, RERA came in. Post that, or even prior to that, reputations had already been ruined, because everybody thought that real estate never goes down. I mean, I remember as an investment professional, I would approach rich people for their money, and they would say, "Listen, I don't speculate in the stock market. I invest in real estate, and it's a safe thing. I'm a safe investor." Actually, if you reflect, they were only reacting to the recent 10, 12 years of performance of the sector. They were not really safe or unsafe. They were attracted to the greater returns of one asset class vis-a-vis the other. And since it went up in a straight line, there was this attraction. But that attraction turned into something else over the last 10 years or so. And people are really irritated with this sector. So during this period, few of the largest players have sort of come out with a lesser taint on their reputation. I'm talking about the Godrejes and the DLFs and the Oberois and the Prestige and the Brigades of the world. Very few. And these are the people who are going to thrive now, because they have this thing called trust. So it's not just a nice to have. It's a critical business advantage. If you have the brand, if you have the trust, people are going to give you money before you start constructing. If you do not have it, people are going to give you money after you have completed the construction. So there is a working capital implication over here, and there is also a pricing implication over here. The guy who has outside capital can easily afford larger project with greater facilities and amenities. The guy who has to dip into his own capital and who is dependent on banks necessarily will have a smaller and a lesser profile project. So it is, this trust plays out in multiple dimensions, and it has real hard return on capital implications, and for the same reason it has share price appreciation implications. So that's how trust works in this industry, and because trust is so critical, to your point, people are not going to abuse it, and those who abuse it, they will come to a lot of grief.
And the trust is not just with the buyers, right? It's also the other side of it is the lenders who obviously play a critical role
Yes.
in financing these projects would be way more likely to lend to some of the people that you mentioned versus, a XYZ developer. So yeah, sorry. Go on.
No, that's a very important point that you brought out. So one is the other people's money, which is like working capital. Like I want a house, and I go to a reputed builder, and he says, "Oh, you pay me slab wise," and I agree to pay. So that is one aspect. The other is, like you highlighted, banks. Banks would like to go with reputed people. That is a natural thing across industries. But there is a third aspect to it, is that is private equity. Anything which can deliver in a somewhat reliable fashion 21-22% IRR, that is naturally attractive to investors. And these are not the kind of rates that you will earn in your home country. You have a lower cost of capital, but then the returns on capital also are very low over there, related to the risk that you are willing to take. Here, for a lesser risk, you can get these high returns. Hence, if you go across, almost all the builders, the large real estate companies, will do projects in conjunction with a KKR, with these Canadian pension funds, or New York Life Insurance. That is another source of kind of capital that comes in, which allows you, even though the terms may be same during that within that SPV, but it allows you to go for scale. It allows you to go for a much better quality kind of a project. So yeah, trust also manifests itself in bringing bank money as well as private equity money.
And along with private equity, another somewhat recent development, at least in India, has been the establishment of REITs, or real estate investment trusts. So how do you look at that aspect of the overall real estate space, and how do you evaluate a REIT? What is it that you're looking for?
So REIT, I mean, there is this mega theme that is running through India, which is unorganized to organized across different industries. So is the case with real estate. Now, real estate is a big term. I mean, so far we have been talking about houses, but what about shops? What about offices? So-called commercial. So REITs relates to the commercial aspect, where you are looking for an income stream rather than a complete sale. So, but then capital is always a constraint. How do you recirculate your capital? So you need a vehicle through which you can share the proceeds, the rental proceeds from your commercial properties. You can sell it, part of it, to them, and use those proceeds to go for the next project, and that is where the REIT comes in. And this is also part of the meta theme of financialization. So rather than owning a home, why don't you part own a commercial property? After all, it's so common in India to hear about the male member saying that I want to have more property so that if something happens to me, my family can live off the rent. This is almost a universal desire, and REITs allow you to democratize that. Rather than, I mean, very few people can afford a very large monolithic kind of investment, but REIT allows it to be almost like a mutual fund. So it plays a very, very important part, and it deepens and it hastens the process of unorganized to organized. Obviously, it is linked to the bond rates, etc. But I think it's a very viable option for people to consider, especially in the early days where only the highest quality projects are being put into REITs.
Yeah, and how do interest rates sort of affect this entire space? Obviously, right now everyone is talking about higher interest rates, and even if they don't necessarily keep rising, there'll be some plateauing at a higher level than where they are today. So how do you factor in interest rates into your assessment of the space?
So that's a very that's obviously it is detrimental. I mean, if the cost of capital goes up, the value of the asset goes down. That is financing 101. But I feel that in the Indian conversations, interest rates as it relates to real estate is given more importance than it deserves. Please understand, real estate has its all. It is somewhat of a given good in the sense it becomes more attractive as it rises in price. Like a share becomes more attractive as it rises in price. So there is an element of pride, there is an element of desire when the property that you live in or the property that you're contemplating actually goes up. So these things, I mean, this I think is a little bit of a lesser understanding that commentators have. Oh, the prices of land have gone up, hence the real estate industry will not do well. Or, oh, the interest rates are going up and people will make it, I mean, where people will shun it. As I already mentioned, the first part, it is somewhat of a given good. The second is that there are, thanks to finance, I mean, finance is, it involves a lot of creativity. It brings in, so all people have to do, or the home loan companies, for a younger borrower, they extend the repayment period, and the interest rate does not affect the daily life of the borrower. EMI remains constant, and you just extend it as long as you have age on your side. So it is not directly impacting in the manner that looking at 6% going to 7%, leading to a 16% derating in the value of the asset. It does not happen like that.
Yeah. And so I suppose interest rates in some ways is most crucial to the third pillar of the entire real estate space, which is the lenders, which we spoke about briefly.
Yeah.
So another way to play real estate is indirectly through companies that lend either in terms of home loans or lending money to developers. So do you think that I suppose in the Indian context, it's predominantly banks, but do you think that that is a safer way to play real estate, or it's better to stick with the actual developers?
You can do both. I mean, you know, the biggest industry, the biggest investment sub-asset class in the listed market is lenders. BFSI is what? I mean, more than 1/3 of the Nifty. So clearly, I mean, you don't need me to say it. It's there. And also, many of us have grown up on this HDFC as a stock, how it has delivered, not the bank, the home loan institution. It has made fortunes for so many people. And along with it, now there are n number of home loan companies, and they do attract patient capital, and shareholders do make a lot of money by being investors in home loan kind of companies. So absolutely agree with you.
Yeah. And just the last question on this topic, there's always a debate whether it's better to invest in already well-developed markets. So, for example, Bombay, Delhi, maybe Bangalore, Chennai, something like that, versus investing in, let's call them tier 2, 3, 4 towns where, there may be sort of more space to grow. So how do you look at that? Are you always looking for developers in smaller cities, or do you prefer sticking with the established guys in the metros?
So, Krish, these are early days. These are very early days, and it makes more sense to be with the largest, the metros, and to be with the largest and the most highest quality kind of home manufacturers. And that's where most of the action is, because cities are going up vertically. There is a lot of scope to grow while remaining within the metros or the tier 1 cities. And also there is better kind of compliance. You can send your analyst and check whether the number of stories or the floors is going up and all. So for a variety of reasons, I think at this phase of the evolution of the sub-asset class, I think it makes sense to be with the largest and in the busiest cities of the country.
And so let's actually talk about the second sector I wanted to discuss with you, which is healthcare. And within healthcare, more the hospital section of the business. Traditionally, a lot of people have held the view that hospitals are not a great investment as a shareholder, because as the shareholder, you're actually, in a sense, the runt of the litter, because you're the last guy getting to the feeding bowl. The real beneficiaries are the doctors and some of the other stakeholders in the entire value chain. Do you subscribe to that view, or do you think that is a wrong conception and there's actually a lot of opportunity as a shareholder in a hospital?
So I think most industries go through an evolution. We are very familiar with the S curve, etc., etc. As it pertains to hospital investing, I think you're right. Initially, when I was growing up, we never used to touch. There was only Apollo was listed, and we never used to touch it because we said let the private equity people bleed the money. There is no ROI. The listed market is very much focused on return on investment, and these companies never would show you any return on investment. But then, just like the hotel industry discovered in the late 90s or early 2000s that there was a way to, divide the ownership of land and the ownership of land and property and the running of the institution into two different stakeholders. Similarly, hospitals also, sometime in the late 2000s, they also reached that point in their evolution. Because you know the usual thing, it costs you around a crore per bed, and if you're going to spend a crore per bed and you're making 25,000 per day, and you even that is there is a 60 to 80% kind of a utilization, so you found that the ROI was really pathetic. So there was a logic in the market avoiding, there were very few hospital companies that were listed in any case, and they were best left to the private equity people. But over the last decade or so, decade plus is what I've observed. Like I said, just like in the hotel was also very similar. And as long as you had a monolithic business model, it was a disaster. There was no returns. But when you divided it up, that the land and building is made by some rich individual or by a real estate company, but the management is done by a Westin or a Taj or by any other brand. That works for both the stakeholders. Similarly, hospitals also, and it is part of the overall rubric of unorganized to organized. Hospitals were never unorganized, but they were charitable, government owned and all. And organized, by that you mean the private sector for profit. So as the for profit private sector has sort of evolved, they have come upon the same fork on the road as the hotel industry did. And now it is very common for the land and building to be owned by typically a real estate company, because they're building a township and they want that township to have value, accretive assets like education and tourism and hospitals and healthcare. So that's how it is done. Or they could be some rich individual or some other person who already owns the land. So the management and the investing in the medical facilities is done by the hospital company, and the real estate is done by somebody else. And you just reduce your EBITDA margin a little bit in terms of the lease rental that you pay, but what you get in return is higher ROC. As such, now you have the sector is eminently investable. It is attractive. One more aspect is the maturity profile. Initially, when you are starting out in life, you have one hospital, or maybe you have very few hospitals. The ratio of mature to new beds is skewed in favor of the new beds. So new beds, it's an upfront investment. Even if you say somebody else makes the building, it still costs you 40-50 lakhs per bed. So, and when you open your hospital in a new area, people don't initially approach you. So you have to do schemes and you have to do arrangements with CGHS or the government or the forces, etc., to give them discounted rates in some shape or form to get off the ground, to get started. So the twin problems of high interest, high depreciation and low capacity utilization with low yields makes the young beds quite unattractive, and hence the thinking that, oh, you break even in 6 or 7 years. And so invest in a hospital when bulk of the beds are close to 7 years and you will do okay. That was the kind of received wisdom. With the breaking up of the ownership of land building and this thing that and the medical facilities, that break-even point has now reduced to 3.5, 4 years, 3.5. So which is the case with many other industries, 3 to 4 year payback. I mean, I'm talking break-even in this case, and the other it is payback, but it's become much more interesting now, and which is why you see a proliferation of IPOs, and it is now occupying a healthy weight in any mutual funds portfolio.
One of the most successful companies in this space globally is the Mayo Clinic. And a lot of people attribute their success to the fact that when patients go there, they are interested in the Mayo Clinic brand. They almost often don't even know who the doctor is going to be. So it's a case where the hospital or the clinic or the institution has been the attractive factor versus any individual doctor, which is often the case. It's like, I want to meet Dr. X for this and Dr. Y for that.
Yes.
And so whichever hospital he or she happens to be associated with is where I end up. Do you think that that model is required for superlative returns in this field? Or do you think that even if the preponderance of doctors continues, a hospital or a hospital chain can be successful?
So right now, we are in the process of going towards the Mayo Clinic model. The reality, as you already outlined, is that if my near and dear one is going under the knife, I want the best surgeon, and I will go to the hospital where that best surgeon is operating. But it's an endeavor on the part of hospital managements to bring the brand to the fore, the hospital brand as opposed to the doctor's brand, and quite so it's a process. It's a work in process where we are undergoing this journey. By and large, it is the doctor brand that is doing well, but with each passing year, the brand Apollo, the brand Max, the brand Fortis, or these brands are also now coming. It's an evolution. Be that as it may, even today with this kind of a hybrid model where partly it is the hospital brand and partly it is a doctor's brand, the returns on capital are quite adequate. And the other thing which I like, even with the current situation being what it is, the demand supply mismatch is such that we've got data because these hospital companies listed themselves only in 2010, 12. That is the time when so many of them, and since then a lot of listed history is available. So hospitals like to give out something called average revenue per operating bed, RPOB. And so we have the RPOB data for now 8-9 years, and we found that each year they are able to increase RPOB greater than inflation. So that tells you that is pricing power. So a business that has pricing power and barriers to entry, and they frequently go together, that becomes an attractive investment, even though we have not evolved to a point where the brand is much more important than the surgeon or the doctor.
And another aspect that maybe people don't always talk about for the growth of hospitals is actually the growth of insurance.
Yes.
As more and more
Yes.
people are insured, they're more likely to go to established hospitals, and because they don't have that risk of having a sudden massive
Yes.
expense relative to their overall net worth. So how do you look at that piece? How do you look at the connection between growth in insurance and the sort of growth in profitability and just general growth of hospitals?
There's a very, very strong connection. If you want to democratize healthcare, because the government hospitals have not been able to do the job to the full extent, so the job falls onto the private sector, and the private sector is focused on growing RPOB greater than inflation. So how do you break this? So health insurance really is the biggest tailwind that is being provided. Maybe over time it will evolve into a, what do you call that, Kaiser Permanente model, where the hospital and the insurance company and everybody is one, so that you have a outcome based pricing. But right now, health insurance is a very strong tailwind.
I want to talk about something a little more general which applies to investing as a whole, which is the debate people sometimes have on whether what is most important when evaluating a company. Is it and value creation, which is, should a company be focused on growing earnings or like P&L earnings, or focused on free cash flow per share? And finance always tells us that the ultimate metric is free cash flow per share.
Yes.
But if you look often, maybe in somewhat shorter time frames, what results in meteoric rises in stock prices tends to go with rises in earnings per share rather than free cash. Like,
Right.
they may not even be generating free cash flow, but because earnings are growing, they tend to do well. And that is often when you see the multiple expansion. So where do you fall on this debate? And do you think that there is an over-reliance on earnings and not enough focus on free cash flow? Or do you think that the way things are is how they should be?
So yeah, we have all heard of that phrase, top line is vanity and whatever. So
Bottom line
clear-
is sanity.
and the cash flow
Yes,
is reality.
yeah.
So, very clearly FCF, but you want to contextualize it. In a capital scarce and opportunity rich economy like ours, FCF is actually a crime. I mean, you should be investing. You should be putting the money back into high return projects. And if you can't do that, then you should dividend it out and have a family office or a in-house VC firm that sort of does that. But that's a different topic altogether. So I think OCF is very important. So, and the link between OCF and EBITDA and OCF and PAT, these are things that a thorough analyst should focus upon, because we know that managements like to play games. That being said, I mean, it is a reality in life, and it's all over the world that jo dikhta hai wo bikta hai. Everybody is looking at the P&L. That is the most visible thing that you can see, and the change in earnings, a change in. So we have been looking at this, internal work we were doing. So we said, what moves the needle more, sales or EBITDA or bottom line? So we found that bottom line moves the most, EBITDA the second most, and sales the least. Though you would have said, you would have thought that sales growth is very, very important. No, I think it's earnings growth which is pretty much important. And also, just to digress a little, people say they'd like to identify as growth investors or value investors. What I have found is that in India, at least, a business cycle investor is the smartest one. That Havesu mentality, that now what? So, in the coming year, if there is going to be a lot of capex, although capex is going to deliver rich rewards in the future, but it is like in the next 1 or 2 years, what's going to happen, and if it is going to sort of pull down the return ratios. And yeah, the other thing which is very, very, very consistent with share price movement is return on capital employed, return on equity as such. So anything which detracts from that actually subtracts from the share price also. And why does it happen? I mean, you can go into the mentality of Indians, or the fact that the cost of capital is way too high over here and the opportunities are just too numerous. So there is a strong temptation to take money out from one and go to the other, because at the end of it, it is limited. You go to the Western world where the capital is in excess, and by the way, they print a lot of money also. Opportunities are scarce and the capital cost is low. Hence, you start thinking in various terms, dividending, etc., etc. Dividend, by the way, even in India, dividend is very strongly correlated with share price, but not as much as it is in the international markets. So yeah, I think OCF is a better measure than FCF. But if you want to move the needle, focus on ROE and focus on EBITDA growth.
Yeah. And especially in the two sectors that we discussed, I suppose free cash flow is difficult to gauge in those, because they're constantly taking the winnings from one project and reinvesting it. If not another project, in case of hospitals, it could be updating the equipment and the general infrastructure. So I just want to end this this topic on healthcare and hospitals with a question on how do you gauge whether the management is doing the right thing. And what I mean by that is, there's always a temptation to dividend out or distribute money to shareholders. And there is an inherent conflict that if you do that, you're maybe not investing in expanding or improving the existing business. Right. So how do you gauge that management is sort of finding that balance between the two of them?
I think your last word is very important, balance. If you do not dividend at all, then it can be confused with empire building. It's you have an infinite kind of a time horizon, but I have a shorter time horizon. How do I get compensated? So zero dividend is to be avoided, but too much of dividending has its own kind of issues. I think what you need to manage, and most of these industries have a very poor penetration in relation to the total addressable market. So there is every reason to go and invest. But yeah, you need to calibrate it. You know that the new beds do not deliver high returns, and they drag down the overall ROE. And anything which drags down the ROE drags down the valuation. So then you are not serving the shareholders well. So you need to. I think there is a need for calibration. how do you sweat the existing assets, when do you go for the next project, and how do you think of timelines?
Anifa, I want to end the interview taking you back to the first thing that we spoke about, which was your time in the army. A major aspect of investing is sticking through the bad times once you've made that investment, because it may take years for your thesis to play out. So in the army, I mean, not that I was in it, but I imagine there's a lot of focus on persevering, sort of seeing things through, and being able to battle through whatever challenges that you may encounter. So how have you, what lessons have you learned on that front in the army, and do you see a way to implement those in investing, and specifically on this aspect of persevering and seeing things through?
Yeah, so they say the difference between bravery and lunacy is a very thin line, and it is determined after the fact. So, the image of a heroic soldier picking up his rifle and rushing the machine gun nest and all sounds very good. Most of the time, he gets cut to pieces. So, same is the case with investment. It is a lonely profession. I mean, if you want to be with the masses, then you have to be content with mediocre returns. So there is a charm to being the lonely kind of a fighter, but it should not be. I mean, I don't know how to describe it. That the line between perseverance and obstinacy. When are you obstinate and when are you sort of determined? I'll give you an example of a particular stock which has made tons of money for me, and it has had its ups and downs, and right now it's going through some downs. And so my colleagues asked that, why do you get on a plane and you sit with the management even now, and wait for the numbers to come out? So, but I feel that bulk of the returns in my life have come by sticking with good businesses. First, you need to have the ability to determine what is a good business and a good entrepreneur backing that business. But I think usually the persevering but thoughtful investor has the last laugh. In between, a lot of commentators can sort of taunt and say, oh, he's backing the wrong horse, or he has lost it, or something like that. But you can talk about technical analysis. I know next to nothing about it. You can talk about business cycle investing, and I just mentioned that is what the typical Indian investor does. But in my experience, the biggest returns are had when you persevere in a good business. Actually, you find that even the managements don't fully understand their own business. Where is the hope for you to just read one or two investor presentations and claim to be an expert? It requires time, it requires reflection, it requires following through that, oh, this was the project that was spoken about, and what is the outcome? Even if it has failed, what are the learnings? How are we using those learnings to come out with a better project going forward, etc. So I think going a mile deep has worked for me more than spreading myself a mile wide.
Anil bhai, this was a lot of fun. It was really interesting to hear about your experiences. Thank you so much for doing this.
Thanks for having me.
I hope you enjoyed this video. Don't forget to like, subscribe, and hit the bell icon. Thanks for watching.